Welcome. Today we'll explain risk and return capital market theory. Main learning objectives in this lecture. How we can calculate the expected rate of return for portfolio of the investment and describe how diversification affects the return to portfolio of the investments. Then understand the concept systematic risk for an individual investment and calculate portfolio systematic risk beta. And estimate an investor required rate of return using capital assets pricing model. Portfolio returns and portfolio risk. In beginning, what's the mean portfolio? When an investor invests more than one assets, example 3 assets, 4 assets, for reduce the risk. That's based on the diversification. With appropriate diversification, we can reduce the risk without reduce the expected rate of return. Some risk can be eliminated by diversification, and those risks that can be eliminated are not necessarily rewarded in the financial marketplace. Calculating the expected return of portfolio. We can calculate a portfolio expected rate of return. We weight each individual investment's expected rate of return using the fraction of the portfolio that's invested in each investment. Example, if you really invest 25 of your money in stock C with expected rate of return minus 32%. 75% of your money you will invest in stock A with an expected rate of return 12%. What will be the expected rate of return for your portfolio? We can calculate the expected return of portfolio by the portfolio weight for each assets multiply the expected rate of return in by each assets. In last example, if we apply the equation, we will arrive the expected rate of return 82%. That's mean the expected return of portfolio will be 82%. Portfolio diversification. The effect of reducing the risk by including a large number of the investments. That's called diversification. The diversification gains achieved by adding more investments. That will depend on degree of correlation among the investments. The degree of correlation measured by using the correlation coefficient. The correlation coefficient can range from -1, perfect negative correlation, meaning two assets move perfectly opposite directions, to +1, perfect positive correlations. That's mean two assets move exactly together. A correlation coefficient of 0 means that there is no relation between the return earned by two assets. Calculating the standard deviation of return. Now we will see how the correlation coefficient affect on the standard deviation for your investments. Example, if you have two assets A and C, the weight average for the first assets 50%, second assets 50%, the expected rate of return for each asset 14%, and the standard deviation for each asset 20%. In beginning, the expected rate of return for portfolio will equal 14%. Now, if we apply the standard deviation equation for arrive the standard deviation in this equation, we will arrive to 18.7%. That's mean when the correlation coefficient is less than 1, the correlation coefficient in our example was 0.75. That's mean less than 1. It's reduced the risk portfolio to 0.18. The standard deviation was 18.7%. For that, if the correlation coefficient was -1, the standard deviation will be 0. If the correlation coefficient going to 1, the standard deviation maybe to be 20%. While if the correlation coefficient 0, the standard deviation will be 14%. That's mean with low coefficient, we will get maximum benefits. While if the correlation between the investment plus 1, diversification benefit will be no benefits. While if the correlation between investment returns 0, that will be substitutional benefit. Systematic risk and the market portfolio. In this section, we will explain systematic risk. We will focus about the capital asset pricing model. Capital asset pricing model, KAPM, provides relative simple measure of risk. Capital asset pricing model that investors choose to hold the optimal diversification. That include all risky investments. The optimal diversification for the investors that includes all economy assets is referred to as market portfolios. According to capital assets pricing model, the relevant risk of an investment relates to how the investments contribute to the risk. How the investment contribute to the risk. For that, in this section, we will focus on systematic risk. What's the difference between systematic risk and unsystematic risk? Systematic risk component measure the contribution of the investment return to risk of the market, while unsystematic risk, the elements of risk that does not contribute the risk of the market. The large portfolio will not be affected by unsystematic risk that does not contribute to risk market, but will be influenced by systematic risk factors that contributes by risk markets. Systematic risk is measured by beta coefficient, which estimate the extent to which a particular investment return vary with return on the market portfolio. We can estimate beta by using Excel or financial calculator, or we can based on some sources in internet, example Yahoo Finance or any websites for calculate the beta. For calculating portfolio beta, we can measure the systematic risk of the portfolio and calculating by taking a simple weighted average of the beta for the individual investment contained in the portfolio. How we can calculate the beta? We can calculate portfolio beta by probability for each assets multiply beta for each asset. Example, consider a portfolio that is comprised of 4 investments with betas equal 1.5, 0.75, 1.8, and 0.60. If you invest equal amount in each investment, what will be the beta for portfolio? If we apply the equation portfolio beta, we will arrive to portfolio beta 1.60. The security market line and capital asset pricing model. Capital assets pricing model also describe how the beta relate to the expected rate of return that investors require on their investments. Capital assets pricing model help us to determine the expected rate of return for risky assets and reflect the relationship between beta risk and the expected rate of return for the investments. The key insight of capital assets pricing model is that investors will require higher return of investments with higher beta. The straight relationship between beta and expected rate of return called as security market line, and its slope is often referred as reward to risk ratio. How we can to measure security market line? Security market line is a graphical representation of capital assets pricing model that help us to measure the relationship between the expected rate of return and the risk. Security market line can be expressed as following equation, which also referred to as capital assets pricing equation. The expected rate of assets by capital assets pricing model equal risk-free plus beta multiply risk market minus risk-free. Example, what will be the expected rate of return on A asset with beta of 1.49 if the risk-free of interest 2%, if the market risk premium with is the differences between expected return on the market portfolio and the risk-free rate of return is estimated to be 8%. We can calculate the expected rate of return by apply the equation. We will arrive to 13.9% to estimated required rate of return by capital assets pricing model. That's mean by when apply this equation, we observe the relationship between beta and expected rate of return. That's called as security market line. Today, explained risk and return, we focused on capital assets pricing model. Thank you for your attention in this lecture.